Hey everybody, what's up? It is Wednesday, March 23rd. Market down today, folks. So what's going on? We have a couple of things going on. Number one, people freaking out about rates, about Fed monetary policy, Fed talking real hawkish. Everybody over at the Fed, real hawkish. We're going to drive these rates up. And then there were some comments circulating around regarding Russia and the potential use of nuclear weapons. You know, this is getting, that part is scary. And I don't want to, try to downplay that. And I've been saying this from the get-go. You know, the way the West is escalating this and just, I don't know, man. And you got two nuclear superpowers. It's not something I even want to think about. But the comment was from Dmitry Peskov, who was the Kremlin spokesperson when he was being interviewed by Christine Amanpour. Under what conditions will Putin use nukes? And Peskov said, if there's an existential threat to our country, that's their bottom line. And that's also, by the way, would be the bottom line for the United States. I don't know. Maybe the United States already has, is the only country in the world that has already used nuclear weapons. Of course, we know in World War II, 2 atomic bombs dropped on Japan. Anyway, let's talk about markets. I'm fascinated by this whole rate thing. We're talking about 2%, possibly 2%, 2.5% on the Fed funds. I've been around a long time, folks. There was a time we were talking about 20%. And now everybody's freaking out about a 4% or 4.5% 30-year mortgage rate. When I bought my first house, I paid 11.75%. So I've spoken about this stuff before. Everything is relative. I understand. We came off, basically zero rate, 0 to 25. Maybe it's going to go up to 2.5. I think I mentioned this yesterday that there is, from what I can see anyway, there is an upper limit to how far the Fed could raise interest rates, for the simple reason that the Fed pays interest on reserves. And that's a relatively new development. That came about in 2008 when we had Chairman Bernanke, and he asked Congress for the permission for the Fed to pay interest on reserves. Before that, the whole history, it was the U.S. Treasury was the one that was paying interest on reserves. The Fed would set the rate, the Fed funds rate, and Treasury would pay. And then Bernanke said, look, can you give us that, can you give that to us, that responsibility? Because it's just going to help us more in monetary policy and rate setting, etc. So Congress gave Bernanke what he was asking for, was the authorization for the Fed itself to pay interest on reserves. Now, how does the Fed do that? It does that out of its earnings. Where does the Fed get its earnings? It gets its earnings from basically its asset holdings. It has almost 6 trillion of treasuries. It earns interest, so it earns interest on its holdings. And last year, 2021, it made just over 107 billion, which it turned over. I think it turned over 107 billion. It maybe made a little bit more than that. It keeps, whatever it needs to operate. I think that's like a 4 billion budget. It keeps that for itself. It turned over 108 billion to the Treasury. So you can extrapolate from that. It's got 9 trillion in assets. It made 100 billion. So it was that like a little over 10 basis points, 10 basis points, 0.1, what, 0.13, something like that. So think about it. If the Fed raises interest rates to, let's call it 2.5%, all right? 2.5%, if we just round it off, that's roughly what? On reserves of 4 trillion. You got 4 trillion in reserves. If it raises it to 2.5%, that's 100 billion in interest that the Fed has to pay out. It only made 107 billion or 108 billion. If it goes above 2.5%, the Fed doesn't have the earnings to make those payments. Now, it doesn't mean it can't make those payments. The Fed could ostensibly, make those payments and have a negative cash flow, but then it will have nothing to hand over to the Treasury, and I don't think Congress is going to be very happy about that. So there is an upper limit. Ostensibly, there is an upper limit to how far the Fed could raise rates, at least, if they don't want to get, incur the ire of Congress. Because Congress is not going to give them the money. There are lots of Fed haters in Congress. So we're not talking about some crazy spiral of interest rates like we saw in the 1970s. And yesterday I talked about the difference between, that period and now, where that period the U.S. was a huge oil importer, so we had a double negative effect to GDP, that being inflation, which is a subtraction from GDP, and then, the imports, that large, it was a net transfer to the foreign sector because of the large amount of oil imports that we had at the time. Right now, and I just saw the numbers again today, the numbers in the EIA weekly petroleum status report, I mean, they were eye-opening for a number of reasons. Number one, U.S. is now net exporting almost about 1 million barrels a day of crude and petroleum products. So we're a net exporter right now. I think it was like 910,000 barrels a day or 920,000 barrels a day. So round it off, we're about 1 million barrels a day of net exports. That is in addition to GDP, because that gets accounted for as final sales of domestic products. So like I said yesterday, you're going to have a subtraction based on the inflation. Inflation reduces real GDP, but at the same time, you're going to have some added to GDP because of increased final sales. So that's, they're going to cancel each other out, or they're going to at least, it'll offset, that net exporter position is going to offset a little bit of the negative impact from inflation. But let me talk a little bit about these EIA numbers today, because they were really interesting, especially on the export side. I mean, all we hear about is, high prices at the pump, and what's Biden doing? How come he doesn't, increase oil production? Oil production is up, exports are up 30% over last year. 30%. We've increased our exports. In other words, in the midst of this whole sanction bullshit and the banning of Russian oil, not to mention, we've banned Venezuelan oil, we've banned Iranian oil, we're actually sending out more of our product to the foreign sector. About 35% of our domestic oil output, we're right now doing 11.6 million barrels a day. And by the way, that hasn't gone up in 7 weeks. So we've had a big price increase in oil. We've even had an increase in the operating rig count. And we're still flatlining at 11.6 million barrels a day. I mean, for 7 weeks, almost 2 months, we're stuck at 11.6 million barrels a day. So the price has done nothing to spur additional output. And yet, 35% of that output, we're sending off to the foreign sector. We're sending it off to foreigners. I mean, does that make any sense? I think I say this about every other video, and I tweet it almost every single day. I mean, the easiest thing in the world right now would be for Biden to ban exports. I mean, if we're really facing this situation of a tightness in supply of, gasoline and diesel and crude, then why are you exporting 35% of your output? I mean, so foreigners get it, so U.S. Oil companies get the profits, and American consumers. I mean, I'm just saying, I don't have a problem with this policy. I'm just saying, when I hear everybody talk about, hey, what are we going to do about this? And we got to produce more. I'll tell you this right now. If we produced more oil, guess where it would go? That would also be exported. I mean, this was my whole thing against the Keystone Pipeline. You take Canadian oil, you transit that oil across the midsection of the United States to the Gulf, and then what? Then you export it away to the foreign sector. So who gets the benefit of that? Foreigners get the benefit. The Canadians get the benefit. All right? And we incur all the potential environmental risk of a pipeline running right through the middle of the country. I mean, it was the stupidest thing in the world. So I was happy when it was canned, but it may come back again. But it's not going to help in our oil supply. It's not going to help at all, because you can see what's happening right now. The more we produce, the more we send away, because it's just more money in the pockets of the oil companies. They love the situation. If you want to hedge yourself against inflation, buy oil stocks. That's what I've been doing. Buy oil stocks. Here's another thing that I thought was really funny today. Argentina raised its interest rate to 44.5% because inflation is going up. Folks, Einstein's definition of insanity, you keep doing the same thing over and over again, expecting a different result. I mean, how high do they think they're going to continue raising interest rates and then not be able to connect the dots that every time they raise interest rates, guess what? The inflation rate goes up. Same thing with Turkey. Same thing with Venezuela. Same thing with Russia. But I'm going to talk about Russia in a second. But I mean, it's really incredible. You have this mentality. I spoke about it yesterday. It's kind of like, it's like a crazy mythology that they're just wedded to this, and they just keep doing the same thing over and over and over again. And every time they raise the interest rate, what happens? The inflation rate goes up, and they just absolutely cannot make the correlation. The only one who made the correlation, believe it or not, was Erdogan, the president of Turkey. And he forced the central bank to cut rates, but rates are still high over there, and Turkey is running a huge budget deficit and a current account deficit, so that you got three things working against the Turkish lira. I mean, you would really have to, the central bank would have to bring rates down like all the way to zero, and then you'd have to, fiscally, you'd have to take care of that budget deficit, and then you'd see the lira really, really strong. But at least Erdogan had the knowledge of this, and he tried. But I mean, they cut rates a little bit. Still something like, 15% or something like that. It's not going to take away the inflation. It stopped the collapse in the lira when they cut the rate, but, wasn't enough. But here's Argentina raising the rate again, now to almost 50%, 45%. And inflation is just going to go higher because rate setting is price setting. And the Fed is about to do the same thing. Now, we're not going to go to 45%. Because of what I said earlier, there's an upper limit to how high the Fed could raise rates, because they got to pay interest on reserves, and they're going to wipe out their cash flow and not be able to pay interest on reserves if they go anywhere above 2.5%. You'll see, they're not going to be able to do that. So they're talking real tough now. We're going to raise rate 50 basis points every single meeting. So you got 50 basis points already priced in for the May meeting. You got 50 basis points priced in for the June meeting. Then it goes down again. Right now you got like 25 basis points priced in for the July meeting. Who knows? Maybe now we're going to go 50 basis points again. I mean, you're gonna bankrupt, not bankrupt, but you're gonna wipe out your cash flow, Fed. You're gonna wipe out your cash flow. You're not gonna be able to pay interest on reserves. Then what? You're gonna go slinking over to Congress saying, "Oh, we can't, we can't send you any money this year because we have no profits, and in fact we're running with negative cash flow. Can you help us out, because we can't even pay for our own expenses? Congress is going to go nuts. So they're not going to do it. They're just not going to do it, and everyone's freaking out over a 2.5% Fed funds rate. It's just idiocy. It really is. People are going crazy over this. So the market was down today, but we needed to see. I like this because we're going to have to go up in a stair-step fashion. You don't want to build up bullish sentiment very, very rapidly, because that'll kill the rally. You want this wall of worry, and we have a legitimate wall of worry in this war, which is horrible, and I really hope it ends without everybody getting annihilated. But economically, fiscally, I've been telling you, fiscal is strong. Bank credit is unbelievable. Banks are the most undervalued stocks in the whole entire market. I mean, it's unbelievable. You got record assets. You have improving residual, which is capital. You have loans, that's the real meat of profits for the banks. Those are going up. So, and these stocks are still really, really beaten down. Really, really beaten down. And people are all like, oh, the yield curve is inverted and they borrow short and they lend long. No, they don't. It has nothing to do with that. They price a loan based on the ability of the borrower, and the loan creates the deposit. You don't borrow money and then lend it out. That is a fallacy. That is not how it works. So a lot of stuff going on today. I like the pullback. Every time there's a pullback, I just add to my portfolio. I add stocks, and one of the ways I like to do it is put limit orders in below the lows of the day. All right, and just to me, it's like going fishing. You bait your hook, you throw your line out there, you sit back and you wait. You place your orders below the market. You allow the market to come to you. You never chase the market. You allow it to come to you. As the market pulls back, you'll get your orders filled, and then, as long as conditions are good. And I'm not going to change my mind on this unless I see, like I said, who knows, maybe the midterms, we're going to see big change in fiscal policy if the Republicans take control. I don't know. I doubt it, though, because they're never going to cut defense. And as I mentioned in past videos, there's 4 big spending components in the budget, and that's Social Security, Medicare, Medicaid, and defense. They might cut the meds. They're definitely not going to cut defense, and they're not going to cut Social Security. So that's it, folks. You got to buy the dips. Oil's going back up, as I said. Actually, the EIA report today was bullish. I mean, there are tight inventories. Oh, let me add one thing. There was a small drop in gasoline demand in the week ending March 18th. But distillate demand, hey, diesel fuel, that's the economy, that's commerce, that was at a 4-month high. Diesel fuel popped up. Diesel fuel demand rose at the most in 4 months. Diesel fuel demand, or distillate demand, I should say, increased by the most in 4 months. So I don't see any real impact so far on the demand side from prices being where they are. And supplies are low. Exports, like I said, we're sending all our product out to the foreign sector. So they're going to enjoy all that stuff, and we'll be paying higher prices. I don't mind, because I'll make the money in the market. If you're smart, you'll make the money in the market. But I understand that people are upset, but they're blaming the wrong thing. We're not. If you talk about U.S. energy independence, it's not independence for us. It may be independence for the foreign sector, where our oil companies are selling our stuff. You could see it. Up 30-40% over last year, despite everything that's going on right now with sanctions and everything else. I don't make policy. Don't blame me. All right, folks. See you tomorrow. Bye.